Stop whatever you are doing right now, not in a minute, not after this paragraph. Right now, close the spreadsheet, pause the workout, put the phone face down, because what you're about to hear is more important than your job, your reps, or your routine. And if you own silver in any form, coins, bars, ETFs, futures mining stocks, do not check your portfolio yet. Do not look. Do not react, because reacting too early without understanding the full picture is how people lose fortunes. What I'm about to walk you through is not speculation. It's not hype. It's not a theory pulled from social media. It's raw, verifiable data released today that exposes something most investors never believed could actually happen. Data that should not exist in a functioning market. Data that tells us with mathematical certainty that the paper-silver system is no longer strained, no longer stressed, but fundamentally broken. Ladies and gentlemen, it is Wednesday, January 15th, 2026, at exactly 2:00 p.m. Eastern Time. The Chicago Mercantile Exchange published a number that stopped professional silver traders in their tracks, a number that triggered silent panic inside bullion banks and institutional desks around the world, a number that signals the beginning of the end for paper silver as we know it. And here's the most important part. This event does not affect everyone equally. Depending on whether you own physical metal or paper promises, the next 30 days could make you dramatically wealthier or permanently lock in devastating losses. That's why you need the entire story before you act. I've spent decades analyzing commodity markets, watching stress build quietly long before it becomes visible to the public. What happened today is not a random spike. It's the result of years of structural imbalance finally snapping under pressure. In this series, I'm going to show you exactly what happened, why it matters, and what comes next. Step by step, number by number, without emotion, without hype. Turn off notifications, stay focused. Because once you see what the market just admitted at 2 p.m. today, you will never look at silver or paper assets the same way again. If this kind of deep, data-driven market breakdown matters to you, make sure you're subscribed and drop a comment with where you're watching from. Let's start with the numbers, because numbers don't negotiate. They don't spin narratives. They don't protect reputations. Numbers reveal reality, and today the numbers revealed something the silver market was never supposed to show. Today was first notice day for the February COMEX silver contract. This is the moment when futures buyers must declare whether they want cash settlement or actual physical silver. In a normal functioning market, most traders never take delivery. They're speculators trading price, not metal. Historically, only 5 to 10% of open interest stands for delivery in a major month like February. That's normal. That's how the system survives. But today, normal ceased to exist. At exactly 2:00 p.m. Eastern, the exchange reported that 47,012 contracts stood for physical delivery, 47,000. Each contract represents 5,000 ounces. That translates to roughly 235 million ounces of silver being demanded for February delivery. This is not theoretical demand, this is contractual demand. These buyers are explicitly saying, do not pay me cash, deliver the metal. Now look at supply. According to the latest COMEX warehouse report, registered silver inventory, the silver actually available for delivery stands at just over 23 million ounces. 23 million ounces available, 235 million ounces demanded. That is a 10-to-1 mismatch. This is not a tight market. This is not a squeeze. This is mathematical impossibility. You cannot deliver metal that does not exist. In a typical February demand averages around 45 million ounces against roughly 100 million available. Comfortable, boring, forgettable. Today's ratio is more than 20 times worse than historical norms. If you plotted this on a chart, it wouldn't spike. It would break the scale. And this happened on first notice day, which means the clock has started. The exchange now has weeks, not months, to solve an equation that has no solution. Everyone saw this data at the same moment. Banks, funds, industrial buyers. And the same question echoed across the market: what happens now? To understand why today's number is so dangerous, you need historical context. Without it, 47,000 contracts is just a big number. With context, it becomes a flashing red warning light that the system is failing. Over the past decade, a normal February delivery month averages around 9,000 contracts standing for delivery. Some years it's 7,000, some years it reaches 12,000, but 9,000 is the mean. Multiply that by 5,000 ounces per contract, and you get roughly 45 million ounces of demand. On the supply side, COMEX registered inventory during those same February months typically ranges between 80 and 120 million ounces. That's how the exchange stays solvent. More metal than claims, margin for error, stability. Today obliterated that framework. Instead of 45 million ounces demanded, we have 235 million. Instead of 100 million ounces available, we have 23 million. The demand-to-supply ratio didn't just worsen, it inverted. The system moved from fractional reserve to fractional fantasy. This is not a 2 times anomaly, it's not even 5 times. Compared to historical norms, today's imbalance is more than 20 times worse. That's not stress, that's failure. If this were a bank, regulators would already be at the door. If this were an airline, the planes would be grounded. And remember, this is only the beginning of the delivery window. First notice day is when intentions are declared, not when the metal actually changes hands. That means the exchange now faces weeks of escalating pressure, daily inventory reports, and constant scrutiny from participants who understand exactly what these numbers imply. At this point, every major player is doing the same calculation, not emotionally, mathematically. How does an exchange deliver 10 ounces of silver for every ounce it actually has? The answer is simple and deeply uncomfortable. It can't, which means something has to give. Either demand collapses, supply magically appears, or the rules of the game change mid-play. In the next chapter, I'll explain why the normal mechanisms that should fix this imbalance are not working this time, and why rising prices are failing to stop demand. In a functioning market, this problem would already be fixing itself. Economics 101 tells us that when demand overwhelms supply, price rises until balance is restored. Higher prices scare away marginal buyers and incentivize holders to sell. That's the theory. That's the model. That's how commodities are supposed to behave. But that is not what's happening here. Since the beginning of the month, the silver price has already surged sharply. In just 2 weeks, paper silver climbed from the mid-80s into the low 90s. Under normal circumstances, that kind of move would crush delivery demand. Speculators would back away, leverage would unwind, open interest would shrink. Instead, delivery demand exploded. 47,000 contracts stood for delivery after a major price increase. That tells you everything you need to know about who is buying. These are not momentum traders chasing a chart. These are not retail investors panicking on headlines. These are buyers who are indifferent to price because price is not the objective. These are industrial consumers who need silver to keep production lines running. These are manufacturers whose costs are secondary to continuity. These are institutions reallocating reserves away from paper assets. When buyers are motivated by necessity rather than profit, demand becomes inelastic. Price increases don't reduce it, they confirm urgency. So what about supply? Why hasn't metal flowed into the system to meet demand? Because the second mechanism is also broken. Most silver in COMEX warehouses sits in eligible inventory. It's real metal, but it's not pledged for delivery. Owners can convert it to registered at any time if they trust the system. Right now, they don't. Converting eligible silver means risking permanent loss of that metal during a shortage. Once it's delivered, it's gone. As a result, conversions have been minimal. Only a few million ounces have moved, barely denting a shortfall measured in the hundreds of millions. Holders are choosing custody over yield. Control over promises. That's the trap. Price isn't reducing demand and supply isn't responding. The gap isn't closing, it's widening. In the next chapter, I'll show you why arbitrage, normally the final pressure release valve, is completely dead in the silver market today. When price signals fail and inventory refuses to move, the final mechanism that should restore balance is arbitrage. In every healthy commodity market, arbitrage is the escape valve. If silver is scarce in one location and plentiful in another, traders buy where it's cheap, ship it where it's needed, and the price gap closes. That process is supposed to be automatic, Right now, it's not just strained, it's dead. For arbitrage to work, there must be surplus somewhere. There isn't. The most obvious source would normally be Asia, particularly Shanghai. But Shanghai is not in surplus. It's trading at a massive premium to COMEX. When a market trades at a premium, it's telling you supply is tighter there than here. Shanghai silver is more expensive because Chinese buyers are competing aggressively for limited metal, and that silver is trapped. New export restrictions mean metal entering China does not leave without approval, and approvals are not being granted. Even if you could buy silver in Shanghai, you couldn't ship it west. The arbitrage door is closed. What about sourcing metal from other regions? In theory, silver could be pulled from London, Dubai, or private vaults. In reality, logistics kill that option. Moving large bars across borders takes weeks. The February delivery window is measured in days. Even if metal could be found, it cannot arrive in time, be certified, and be delivered before the clock runs out. Then there's the final problem. The players who normally execute arbitrage are the bullion banks themselves. And they are frozen. Buying physical silver to meet delivery obligations means locking in massive losses. Many of these positions were sold far lower. Covering now would be financial self-harm. So they wait, they hope, they stall. That's why arbitrage is not expensive, it's not delayed. It's impossible. No surplus, no time, no willing buyers. The mechanism that has quietly saved the system for decades is gone. And when arbitrage dies, markets split. In the next chapter, I'll explain why this failure has created two separate silver markets and why one of them is about to become irrelevant. When a single price can no longer clear a market, that market fractures. That is exactly what is happening to silver right now. We are no longer dealing with one unified silver market. We are dealing with the two completely different markets that just happen to use the same word. The first is the paper market. This is the futures market where contracts are traded, rolled, and settled on screens. It is designed for exposure, not ownership. In this market, silver trades in the low 90s. Liquidity appears deep. Volume looks healthy. But what today revealed is that these contracts are claims without sufficient backing. The second is the physical market. This is where real silver changes hands. Bars move, vaults empty, delivery matters. And in this market, prices are radically higher. Asia trades at triple-digit prices. India trades far above that. Retail markets charge enormous premiums or show no inventory at all. Which price is real? The one where metal actually exists. The 47,000 contracts that stood for delivery today represent buyers calling the bluff of the paper market. They are saying you promised metal, deliver it, and the exchange is discovering that it cannot honor that promise at scale. When delivery fails, contracts lose meaning. A futures contract is only valuable because it can be converted into the underlying commodity. Once that link breaks, the contract becomes a cash-settled bet detached from reality. That is not price discovery. That is theater. This is why confidence matters more than inventory. Once participants believe contracts will not deliver, they stop using them for hedging or protection. Open interest collapses, liquidity evaporates, and the paper price becomes irrelevant to anyone who actually needs metal. We've seen this before in other markets, but rarely at this scale. The difference here is size and timing. Silver is embedded in industrial supply chains, energy systems, and national reserves. When the paper market fails, there is no substitute. In the next chapter, I'll explain why recent attempts to suppress this move failed, and why margin hikes and rule changes no longer work when the buyers don't need leverage. 2 weeks ago, the exchange tried to stop this before it became public. They used the last tool that has worked in past cycles, margin hikes. Requirements were raised sharply, shifting from fixed amounts to percentage-based calculations tied to contract value. The objective was simple: force leveraged traders to sell, break momentum, reduce delivery demand. For a moment it seemed effective, prices dipped, volatility spiked, some positions unwound. Historically, that's where rallies die. But this time, the market did something unexpected. Buyers returned almost immediately and with more conviction than before. The reason is critical. The buyers driving this move are not leveraged Speculators, they are fully funded institutions and industrial users. Margin does not affect them. They are not borrowing to trade price. They are paying cash to secure metal. That distinction changes everything. When demand is speculative, margin works. When demand is structural, margin is meaningless. You cannot shake out a buyer who needs physical silver to operate or to protect reserves. Price volatility doesn't scare them. Paper rules don't stop them. As a result, the margin hike failed, price rebounded, delivery demand surged, and the exchange exhausted its last reliable control mechanism. Now the situation becomes existential. What options remain when margin no longer works? Trading halts, emergency rule changes, forced cash settlement. Every remaining option publicly admits that contracts may not deliver, and once delivery is questioned, confidence collapses. Confidence is the foundation of the paper market, and today's data proved it is cracking. In the next chapter, I'll explain why the institutions on the short side are now trapped, and why this moment represents their worst-case scenario unfolding in real time. The institutions on the short side are now trapped. For years, major bullion banks carried large silver short positions relying on one assumption: most contracts would never demand delivery. Cash settlement was expected, physical metal was rarely required. Today broke that assumption. Nearly half of all open interest is now demanding silver. These are not estimates or forecasts. These are legal obligations, and the banks responsible for delivery do not have the metal. Their options are both damaging. They can attempt to source physical silver, but supply is unavailable at scale. Miners have sold forward production. Refiners face long lead times. Overseas markets are in deficit. Private holders are not selling. The metal simply is not there. Or they can invoke emergency settlement mechanisms. Force cash settlement. Declare extraordinary conditions, but doing so publicly confirms that paper contracts are not backed by sufficient metal. Once that confidence is lost, it does not return. That is the trap. Delivering metal locks in massive losses. Admitting failure destroys the credibility of the market itself. There is no clean exit. Meanwhile, registered inventory continues to decline. Every ounce that leaves tightens the noose. Time is not a neutral factor here. It accelerates failure. This is how systemic breakdowns begin, not with chaos, but with institutions frozen between impossible choices. In the next chapter, I'll explain why this silver crisis is not isolated and how it connects to broader stress across global markets. Silver is not collapsing in isolation. It is the most visible fracture, but it is not the only one. What we are witnessing is a broader loss of confidence across paper markets, and silver is simply where the math failed first. Look at gold. Gold is pushed to new highs not gradually but aggressively. That is not a trade. That is a signal. Gold rises like this when trust in currency weakens, when investors question the stability of debt, and when central banks lose credibility. Gold is not reacting to silver. Silver is reacting to the same underlying stress. Now look at bonds. Sovereign debt is being sold not because yields are too low, but because risk is being repriced. When investors demand higher yields, they are saying they no longer trust the promise behind the paper. Debt markets are cracking under the weight of obligations that can only be rolled, not repaid. Equities are feeling it next. Companies that rely on industrial metals are facing margin compression, supply disruptions, and production delays. When commodities become scarce, financial models break. Earnings forecasts fail. Valuations collapse. This is not a stock problem. It's a resource problem. Silver sits at the intersection of all of this. It is money and material. It is financial and industrial. When silver breaks, it exposes weaknesses everywhere else. That's why today's data matters far beyond one contract month. This is what systemic stress looks like before it becomes obvious. Paper claims multiply. Physical constraints tighten. And eventually reality asserts itself. In the final chapter, I'll lay out what this means for you strategically, calmly, without panic, and what lessons this moment offers for navigating markets when systems fail. This is the point where emotion destroys people. Panic selling, chasing headlines, acting late. The investors who survive moments like this are not the loudest or the fastest. They are the ones who understand structure, timing, and risk before the crowd does. The lesson from today is not simply about silver. It's about claims versus control. Paper assets work until they don't. They rely on confidence, leverage, and assumptions about behavior. Physical assets rely on possession. When stress rises, those two worlds separate, and once they do, they rarely reconnect. If you already own physical silver that you control directly or through fully allocated storage, you are not the one who needs to act. You already removed counterparty risk. Your job now is patience and discipline. Systems break before prices fully adjust. If your exposure is primarily paper, ETFs, unallocated products, or contracts you cannot personally settle, then you need to reassess risk honestly.